trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming in to our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy-friendly world, we need all renewable energy sources to work together.
who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act from this side. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared me. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
Yeah, it's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud. A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness. from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy...
Hello, traders. I'm going to place an order to buy Canadian dollar, okay, at 126.71. So please place your order at 126.71, okay? If you want to get the strategy, you know where to get it. All other guys who keep following my trades, order placed. So you have to do as well if you want to trade today. And looks like we're going to fill this order. Let's see, not yet. Let's see how long it will take us. I'll speak to you later, guys. Okay?
So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase them.
Okay, guys, as you can see, position opened on Canadian dollar at 126.71. All of you who decided to trade, well done. Stay with me and we'll go through this trade and we will close this trade together, of course, in profit. Also, we have new dates for our webinar. So all of you guys, first come, first serve. Please register for the webinar. You need to go to company.co.uk website and you can get the link to the webinar. It will be live webinar. I don't do recorded webinars, so you always can ask questions that I will try to answer. On the webinar, this strategy will be included, so you don't have to worry. I will give you strategy as well. Okay? I'll speak to you later. Let's see how far it will go. Oh, it looks like it moved down a little bit, so you still have chance to place an order. I'll speak to you later. Stay safe.
Are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen. That actually this pollution-free all the way to the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. U.S. stocks now well off session lows, right to the numbers. We've got fast-moving markets on this back-to-work Monday, with the Dow now down by 494 points. At one point, the Dow had been down more than 1,100 points. Right now, the Dow is down by 1.4%. S&P 500 index down 67, a drop right now of 1.5%. NASDAQ down 206, a drop there of 1.5%. 10 years up 9/30 seconds, 10-year yield 1.72%. Stocks off session lows amid intense volatility as investors still seek safety in treasuries, with the specter of a Federal Reserve policy mistake and rising geopolitical tensions roiling markets around the globe. Right now, the S&P has cut its losses by half. Earnings also front and center today, with the Federal Reserve earnings big questions for investors. A week that will bring us reports from Apple, Intel, Microsoft, Tesla, and Texas Instruments, among many other big tech names. IBM reports after the closing bell today. Right now, IBM shares, they are lower by just about 2.3%. As for the earnings backdrop, Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets.
Look, this week and next week are brutal. We get well over 200 S&P 500 companies reporting. I would say so far, based on the early reporters, the focus on strong demand, it just hasn't been the same tone as what we've heard the last few reporting season. Labor has been a hot button issue. I think that's replacing supply chains as the theme of the year.
Kohl's shares are surging as the department store retailer fields interest from two suitors at the same time that it's grappling with multiple activist investors pressuring it to sell. Kohl's shares, they are surging today by 33.2% on a down day for the rest of the market. Among other retailers today, we do have shares of Nordstrom up by 11%. Recapping, S&P down 61, down 1.4%. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, we are streaming on YouTube. It is Monday, not a great-looking Monday, January 24, 2022. Good to be back at Bloomberg headquarters.
It is so good to have you back at Bloomberg headquarters and in the studio with me. It's been almost, since 2021.
Yeah.
Yeah, that's what it feels like.
And you gave me a market sell-off.
Yes, that was all me. That was all me. It certainly feels that way, that we're potentially seeing some capitulation. We are off of session lows, but still, this is one, you've seen cycles, Carol.
Yeah.
This is kind of one for the history books.
This is one, it feels pretty significant. It's broad-based, but I mean, I was just kind of kidding with everybody. Those of us who remember reporting during the financial crisis, that was just, you felt like, okay, our system's coming down. That's not this.
No, that's not this, but a lot of superlatives that go back to since March of 2020.
Superlatives on the upside, superlatives on the downside.
There it is. You
That's
got it.
That's a market.
Hey, we're going to talk a lot about markets in the next 3 hours. We're also going to be talking about extreme abstraction when it comes to the financial markets.
It's not a medical procedure.
No, it's not.
No, it's actually about the markets.
It's not.
We're talking about that.
Nothing to be worried about, I don't think.
Yeah, unless you're Peloton. Activists have another target. We're talking about Peloton's CEO. This is an interesting story. Stock did rally, but then it was kind of flat, so we'll talk about that one.
Speaking of news, in this issue of Bloomberg Business Week, the upcoming issue, we're talking targets. Venture capitalists have placed a $1.4 billion bet on news, publishing to be exact. Alex Webb is joining us along with Joel Weber.
And we got the co-founders of Yumi. It's an organic food company, I should say, for kids and babies. So we'll get to that in just a moment. Let's get, though, to the markets and the market drivers report. Let's set your Business Week agenda on this Monday. And joining us is Preeti Gupta, Bloomberg Markets correspondent, and Katie Greifeld, Bloomberg News cross-asset reporter. Quick Take co-anchor as well with Tim, both of them on the phone in our New York City bureau. Preeti, let's start with you. Talk to us about the dynamics of this trade, and I am curious about volume, which to me speaks to conviction in terms of the selling.
Yeah, I would completely agree with that take. The idea that if you do have higher volume, you do tend to see more conviction. What's important to note about it this time, though, is when you also see higher volume, it also means that you are going to likely see a higher VIX as well. And that is a call that some people are saying is kind of signaling the end of the selling period, essentially a bullish signal. You have also talked about the VIX inversion, the idea that volatility is going to be higher now than in the future. At least that's what the bets are making. So put all of that together, and you are already starting to see some of the declines that were as much as 3% on the S&P 500 turn around. But keep in mind, yes, it's a tech-led sell-off, but remember, tech also led the stock market to those gains. It's only natural to see it lead the decline as well.
Hey, Katie Greifeld, come on in here, because I know you've been watching this closely as well. I'm wondering if we're not thinking about it from a technicals perspective and we're thinking about it from an earnings perspective, and this kind of kicked off last week with Netflix and that big miss when it came to at least what they were thinking in terms of subscribers for the upcoming quarter, the current quarter. Tech earnings this week. Plus
Microsoft,
the Fed.
Apple, Tesla, right? Some big ones.
IBM today after the bell.
There's a lot.
There's a lot. What's more important in terms of a catalyst to have a bottom or move higher off of this week? Is it tech earnings or is it the Fed?
I'm going to say it's the Fed. I really think that is the main catalyst this week. But, I mean, to your point, Tim, earnings haven't been the cushion that they have been. But, I mean, even just zeroing in on today's price action, which you never want to do too much of, but we had a bond auction at 1 p.m. Typically, they aren't that exciting. But this was the 2-year tenor, and it was very strong. You saw a lot of demand here, and that's the tenor that would really be under pressure if we were expecting to see a much more aggressive Fed. But people want to buy bonds right now, at least in the primary market. That tells you that maybe some of the Fed pricing that we're seeing, maybe it's a little bit aggressive. And I think that ties in with the intraday rebound that we are seeing in the NASDAQ 100, even though that index is still negative. It's well off its lows of the session.
Well, and that's a really good point. And it all speaks to, in terms of the Fed, what we get from the Fed tomorrow, Creedy, I think about in terms of specifics, right? No doubt about it. We are all ready for policy changes when it comes to the Federal Reserve, but we haven't gotten a lot of specifics, especially from Jay Powell, in terms of how quickly we do it, how fast, how aggressive, and that's what we could get tomorrow that could really kind of set this trend to the upside or the downside in real motion.
Yeah, and to your point, I think there's two pieces of the equation, two questions that we don't have answered yet. And one of the big ones is going to be the balance sheet reduction. And I think a lot of traders are going to be looking for that. Yes, we know that's going to happen later in the year. What we don't know still is how it's going to happen. We don't know whether it's going to mean actively selling bonds on the open market or whether it means buying shorter security bonds and letting them kind of roll off, essentially not reinvesting some of the money that they traditionally would when bonds roll off. So that's going to be major because both methods have very different market reactions. The actively selling bonds on the open market is a far more volatile reaction. So that's going to be question number one for the Fed. Question number two is, of course, is there going to be a potential 50 basis point rate hike on the table in March?
That is crazy.
Well,
come on.
Wow.
Come on.
Let's talk about, though, what's interesting to me, and I agree with you, it is a pretty out there call, but what's interesting to me is that the actual bond market is only priced in 27 basis points, but traders have made the leap that because it's more than 25, therefore it's pricing in a 50 basis point hike, which is an interesting logic.
I will eat mashed potatoes if that's the case, because I really hate mashed potatoes. I'm just going to put it out there. All right, you guys can hold me to it.
All right, we'll hold you to it.
But that's going to be something to see if he even acknowledges that that's a possibility.
Yeah.
Katie, just in 20 seconds, crypto. We can't have you here without talking crypto because guess what? Bitcoin's actually higher right now. Now.
It's fallen a lot.
Yeah, it's fallen 50% from its highs. That's the important context there.
Yeah, don't blink. Again, I'm just going to tie that to that tech trade. If you look at the correlation between Bitcoin and the NASDAQ 100, the 40-day correlation, it's never been higher. So that ties into this entire story we've been talking about. So Bitcoin to bonds, there you go.
Bitcoin basically a tech stock now.
Bitcoin to bonds.
Yeah.
It's like a T-shirt or something.
I know. Oh, you can do that one.
All right. Mashed potatoes. You can hold me to it. Katie and Creedy, thank you. Creedy's going to be back a little bit later on. Let's do the bite of the day.
Bloomberg Business Week. Bite of the day is one number that tells us a lot. Today's number is $603 million.
New Yorkers placed a record-shattering $603 million in bets during the launch of mobile sports gambling, according to initial figures released by the State Gaming Commission. The wagers on football, basketball, hockey, and other sports generated some $48.2 million in gross gaming revenues from January 8th to the 16th. Over the course of that time, New York surpassed Pennsylvania as having the most successful launch. That's a lot.
It's a lot of money in a very short period of time.
Yeah.
That's why these companies were so excited. I don't know. There'll be social studies on this. It is for Instagram, because those are the only ads that I'm seeing on Instagram these days.
All right, let's get to world and national news.
Nancy Lyons is standing by in D.C. Hey there, Nance.
The Supreme Court has agreed to hear a challenge to the consideration of race in college admissions. It now adds affirmative action to major cases on abortion, guns, religion, and COVID-19 already on the agenda. The court says it'll take up lawsuits claiming that Harvard, a private institution, and the University of North Carolina, a state school, discriminate against Asian American applicants. A decision against the schools could mean the end of affirmative action in admissions. Congressional investigators continue to learn more about a draft plan to seize ballots from the 2020 election.
The draft order lays out a plan to empower the defense secretary to seize and retain voting machines connected to the 2020 election. Politico reports it's not clear who wrote the order, but now lawmakers want to know how the military would have been used. Chairman Benny Thompson says the committee has already talked with former Attorney General William Barr and Pentagon officials, and while there was no operational plan to put the order in place, the draft, quote, is reason enough to believe it was being proposed. In Washington, I'm Amy Morris, Bloomberg Radio.
The country may be able to return to a sense of normalcy soon. That's according to Dr. Anthony Fauci, who says the pandemic may reach a level of acceptable control soon, barring any new variants.
If we get there, which I hope we do, and I believe we can, then you're going to start talking about looking at some real returning to the kind of normality that we're all craving.
Fauci says the country now has new tools to better fight variants like antiviral treatments, testing, and of course, those vaccines. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, you're listening to Bloomberg Business Week. Nancy Lyons, thank you so much. Carol Massar along with Tim Stenovic. And 1, 2, 3, 4. How many shots do you think we're going to have?
Ever, or like within a year?
I don't know.
I don't know. I think it's more, look, I don't know anything more than what I read from the experts. I don't necessarily think the data are showing that we're going to need booster and booster and booster over again. I'm thinking more like it's a yearly thing, like we hear from Pfizer.
So we get an annual shot,
yeah, like a flu shot.
Like a flu shot.
Yeah,
right.
I don't know, but look, my information is only as good as the latest studies that I'm reading.
Right, and there was a study released by Israel's health ministry, and they found that a fourth vaccine dose for older adults leaves them better protected against coronavirus infection than peers who had received 3 shots. So,
but these are people only ages 60 and over, right?
So the old folks?
Maybe.
Sorry, I don't consider 60 and above old.
Yeah, I don't either, actually. I don't. But
I guess for medical,
it's a small
right?
portion
A medical
exactly.
age.
And if we think about the population of the world and of the United States, it's a relatively small portion.
Interesting, though. It does feel like the world's getting back a little bit. It does feel like the city was a little bit busier
I told you
today.
this last week, Carol, that I saw, the testing tents were just empty on Thursday. I saw, 8 to 12 of them. They were empty. And then I keep checking the New York City data, and we see the curve continuing to move lower. But we're still at a kind of a really high point in terms of daily cases.
Yeah, right. And so then we'll watch for, in terms of, obviously, deaths, right? That's the next number. I was in D.C. over the weekend and wearing masks and stuff and socially distanced, but did pop into a restaurant. It was pretty crowded.
Yeah?
They're checking vaccine cards. They want to see your ID. I mean, so everybody's kind of doing what they need to do to kind of get back to normal.
Good. Good to hear.
Yeah, so that's going on. Meanwhile, what else do we have? The World Health Organization saying Europe is entering a new phase of the pandemic driven by Omicron's milder symptoms, lower risk of hospitalization, the efficacy of vaccines. So we're seeing this around the globe.
I think we're seeing risk tolerance change too, as well. I would guess that you probably wouldn't have gone into a restaurant a few months ago.
No.
At the peak of different variants, and you're feeling okay about that because of what you know about Omicron and vaccines.
Still wary, and like when I sit down in a restaurant, I want to be like away from people.
I get it.
Including you, Tim. All right, this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Losses for U.S. stocks, volume more than 80% higher than the average of the past month, but right now the S&P has cut its losses by half. The S&P 500 index down 83, that is a drop of 1.9%. The Dow now lower by 613, down 1.8%. Nasdaq down 233, a drop there of 1.7%. 10 years up 8/32, 10-year yield 1.72%. Spot gold's up 0.3%, 18.41 the ounce, while West Texas Intermediate crude is down 2.2%, 83.24 a barrel on WTI. Bitcoin up 1.5%, 35,877 right now on Bitcoin. Pfizer and BioNTech say results from 2 lab studies demonstrate that 3 doses of the Pfizer-BioNTech COVID-19 vaccine elicited antibodies that neutralize the Omicron variant. Pfizer down 4.5%. BioNTech, its ADRs down by 0.8%. Recapping, stocks lower. S&P down 88, down 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic here in our Interactive Brokers studio. We talked about some of the top COVID headlines that are out there. The UK is going to stop requiring vaccinated travelers. Pfizer and BioNTech saying a pair of laboratory studies confirming that 3 doses of their COVID-19 vaccine produce antibodies that can neutralize the Omicron variant. I feel like I'm watching a Marvel movie.
Yeah.
It's like dun, 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 dun.
The last 2 years?
Yeah.
Yeah. Hey, there's also some mixed news coming from New Jersey. We're seeing that an increasing number of severe cases of COVID-19 among children in New Jersey. It's also fueled some outbreaks in nursing homes and other long-term facilities. That's according to the state's health commissioner.
All right, that's good to know. That's my home state. Back on Bloomberg, a voice that we always respect when it comes to the pandemic, Dr. Sandro Galea. He's Dean and Professor at Boston University School of Public Health. He's got a book out that's called The Contagion Next Time. He is with us once again on the phone from Boston. Dr. Galea, nice to have you back with us. How are you, and what do you think are the most important headlines when it comes to this pandemic that we should be paying attention to?
Hello, Carol. Hello, Tim. Happy New Year. Well, it's been 2 years, as people said. I appreciate you were saying it's a bit like being in a Marvel movie. It's been a long 2 years, and I think we're at a point where many of us are beginning to feel like there could be hope. Just to summarize, the Omicron variant, which came and really performed like it had in South Africa and the United Kingdom, which had very rapid rise, and now we're seeing that we've peaked and heading into a rapid fall, which should, over the next few weeks, return us back to where we were before Omicron. And I think what many are expecting is that after that, we'll have a period of stability at low rates of COVID. And you've heard a lot of discussion around, will we move to an endemic phase? And, endemic just means that a disease is around and we're used to it. And tuberculosis is endemic, malaria is endemic. So there's no magic number as to when something becomes endemic. It simply means when we settle on a level that we say we're learning to live with this disease. Now, when that is, of course, ultimately is a judgment call as to when we as a country and when the world gets there. And of course, the big fear remains on my mind, on everybody's mind, is that there will be another variant that we're not expecting. I mean, that's the big question mark in all this, because if there is another variant that we're not expecting, we don't know its characteristics, and that could be a game changer.
And that could still happen, right?
It could certainly still happen, and I don't think you'll be able to find anybody who will come on your show and say that's not going to happen, because we simply don't know. Now the hope is, and Dr. Fauci mentioned this in a talk he gave recently, that Omicron becomes effectively a live attenuated vaccine, and that means that for many diseases we vaccinate through a mild form of the disease itself, and many people who are not vaccinated through any of the vaccines out there have actually gotten Omicron, which means that they've actually also been vaccinated effectively by getting the disease. So the hope is that between those of us who are vaccinated through Pfizer or Moderna, et cetera, and those who were not vaccinated but got Omicron, that there are enough people vaccinated that the reservoir of people who are naive to COVID is relatively few. And by naive, I mean that means that they're susceptible to getting the disease.
And we're talking about the United States, and I think, a concern a lot of people have is a variant of concern emerges outside of the United States and a place that is even more unvaccinated than developed countries. Hey, Dr. Galea, I'm wondering about the natural progression of a virus like COVID-19.
Yeah.
Doesn't it get? I mean, shouldn't as it makes its way through populations, is it the type of thing that gets more transmissible but less severe naturally?
Yeah, that's correct. That is generally what we expect. I feel like every time we talk about COVID, one has to say generally because, of course, we've had many exceptions in the course of COVID. But fundamentally, what happens in the evolution of these viruses is that there are fewer people who are susceptible. So in order for the virus to survive, it needs to become more transmissible. And in order for it to survive, it needs to become actually less severe because if a virus kills its host, then it actually cannot transmit itself. So there is a natural evolution towards more transmissible, less severe. Having said that, there are exceptions, and there could well be exceptions. And as you said, it is of particular concern in places where you still have large numbers of people who are unvaccinated and among whom COVID is circulating. I mean, the Omicron came from South Africa, as we all know. So certainly if Omicron has taught us anything, or if COVID has taught us anything, right, is that the whole world is connected and we are all healthier if everybody's healthier.
Dr. Lea, I want to go back to the transition from pandemic to endemic that you and Carol were speaking about a little earlier. What is your definition of endemic? What needs to happen for you to say to yourself and to say to us, this is no longer a pandemic, it's endemic?
Fundamentally, to get something to endemic, it means it has gotten to a level that we have learned to live with it, that we have adjusted our society and we are back to doing our business, our daily business, our professional business, our living, our life, and in a way, and living with the disease. And in a way, for example, I mean, flu is endemic. It comes in cycles, and we live with it. We don't disrupt what we do because of the flu. We don't disrupt what we do for any number of diseases. So it really, to my mind, would be a return to our next normal living. Now, I say the word next intentionally because it's not unreasonable to have some changes that one makes, recognizing that you are now living with some other new disease that you weren't living with before. But by and large, the expectation is that we will go back to where we were. You know, some diseases are so rare, Tim, that endemicity is zero. So if you have to give one example, for example, something like meningitis.
Right.
Meningitis in the United States is very rare. So even a single case or two becomes pandemic, right? Because endemic levels are zero. But those are some diseases. But many diseases, endemicity is some level. It's a level that we live with. I mean, there's an endemic of heart disease, endemic of lung disease.
Right.
It could be an endemic of COVID.
Dr. Sandro Golea, thank you so much. He is Dean at the Boston University School of Public Health, joining us on the phone from Boston. Check out his new book, The Contagion, next time, because guess what, everybody? There's probably going to be a next time. You're listening to Bloomberg Business Week. Carol Massar, Tim Stanovic, happy Monday. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, folks, it's Monday, and the wall of worry, it's a pretty big one, and that includes what's going on over in the Ukraine and Russia and what the U.S. is doing with its allies.
Yeah, interestingly enough, I would say, Carol, the themes we talk about when it comes to markets, at least of late, hadn't been international relations significantly.
It's usually like U.S.-China?
Yeah,
or...
exactly. And China stuff was really, it was so similar to what Trump has done in terms of U.S.-China relations that it's been really in a vacuum, I think, when it comes to Chinese equities at least, but that has shifted.
Joe Matthew watches everything for the administration. We're going to talk about this with him in just a moment. First up, though, let's get to Charlie Pellet. Hey, Charlie.
Well, hello there, and we've got steep losses across the board. Key takeaway, well-off session lows. Not just those mounting geopolitical tensions. Earnings, a major consideration for investors. And also there is the specter of a Federal Reserve policy mistake. So lots of moving parts. It has been a volatile day, but let me get right to the numbers with the S&P now down by 90. Drop there of 2.1%. The Dow's down 644, have been down more than 1,100, down now by 1.9%. NASDAQ down 284 for the NASDAQ Composite Index, a drop right now of 2.1%. 10 years up 8/32, 10-year yield 1.72%. Spot gold up 0.3%, 18.40 the ounce on gold. And Bitcoin, right now Bitcoin is up 1.6%, 35,936 on Bitcoin. West Texas Intermediate crude tumbling 2.2%, 83.25 for a barrel of WTI. Prime Minister Johnson says the UK will stop requiring vaccinated travelers to take a COVID-19 test after arriving in England. Pfizer and BioNTech say a pair of lab studies confirm that 3 doses of their COVID-19 vaccine produce antibodies that can neutralize the Omicron variant. Dr. Joshua Sharfstein is Vice Dean at the Johns Hopkins Bloomberg School of Public Health. He says just about 2 years into the pandemic, he is optimistic this year will be better than last year.
So many people got Omicron that there's a hope that whatever comes next will be better prepared for. And just like Omicron was milder, in part because there's so many vaccinated and exposed people, we will have an even milder time with whatever happens to come next. That's the hope. I see the World Health Organization has also expressed that hope. So I think we really can start to think about 2022 being different than 2021.
Dr. Sharfstein with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine stocks, Pfizer shares down 4.6%. ADRs of its German partner BioNTech down 1.6%. AstraZeneca down 5.6%. Moderna dropping 7.4%. J&J Johnson & Johnson down 3.3%. Peloton shares, they are higher as investors assess the fate of CEO John Foley and potential acquisition following a report that the exercise equipment maker has received a letter from an activist investor demanding that it fire Foley and pursue a sale. Right now, Peloton shares, they're up 6.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Psyched to talk to, first of all, Charlie, thank you. Psyched to talk to our next guest, really a member of the family. We're going to talk about Washington. I was in Washington over the weekend, and I tweeted this out. Anytime I'm there, I see the Capitol, the White House, I still am in awe. Our democracy not perfect, but it's still... I don't know. There's something about it.
Yeah, it's absolutely an awe-inspiring place. And we're lucky because part of Washington, D.C. is up with us today here in New York City and for the week indeed, and that's Joe Matthew.
He
Good
is
to see you
indeed.
guys.
How are you?
If it gets old, as we always say when you're walking down the driveway of the White House,
Yeah.
when that stops becoming exciting for you, go do something else.
Yeah, right.
Because look, what we do is really hard, for a living. And God, these guys who do pool duty at the White House spend half their day waiting in a van. It's not always the most glamorous work, but being a witness to history and in those beautiful
cool,
places, having access to that is kind of why we do it.
I know some of the fences are certainly down around the off the Capitol, so that has come down.
That's right.
Speaking of difficult things, right now dealing with Russia over Ukraine is a difficult thing for the Biden administration and its allies. Where are we? What do we need to know about all of this?
Oh God! Well, there's a lot that's gone on over the weekend, and it was really something on balance of power to hear people show up on a Monday with different opinions than they had on Friday. This was not a good weekend for this whole situation. The president today, in fact, what is it, about 25 minutes from now, is going to hold a video conference with European leaders, Italy, Germany, France, and so on, the EU, NATO, all on that call. As we now know that there are real concerns, not just posturing, but real concerns about something happening here. So there's a couple of different tracks. We're moving troops, as many as 5,000 troops into the Baltics, into Eastern Europe. NATO is doing the same. We have an aircraft carrier that's over there now just trying to start some exercises. So we've got the big show. Then the question is, well, what happens? What are we going to do with it from here? Because all the while, sanctions are being written on Capitol Hill. Those have not been passed yet, even though you hear the presidents, threaten the most awful sanctions you've ever seen in your life. They're actually crafting that right now.
But easy for the U.S. to do that versus, I think, about the European allies. The European relationship with Russia is a closer one, right, in terms of economics and oil and so on and so forth.
That's true. And keeping the lights on and keeping houses warm this winter, there have been a lot of concerns about energy, specifically when it comes to Russia. Ukraine is very concerned. They're actually, trying to do as much as they can to kind of train up, but they don't seem to feel like this is imminent, and that's kind of an interesting part of this.
Hey, Joe, I can't help think about this without thinking about what happened in Afghanistan just a few months ago, and the public appetite that Americans have to actually see American troops off to another foreign land after, after what happened in Afghanistan. How is the Biden administration threading that needle?
Well, I'm not, look, some would suggest that this might not be happening if it were not for Afghanistan, that Vladimir Putin watched that and said, okay, I see an opening. Wow. And when you consider the way we're working with Ukraine, when you consider our relationship with Taiwan and the way we've interfaced with China, they're all looking at how you guys handled Afghanistan as maybe a blueprint here. And it may have emboldened Putin is what the conventional wisdom would be. I just have a hard time getting people to answer the question, you really think anybody wants to go to war here, or getting a yes to that? Vladimir Putin doesn't want to get in a hot war with the United States, and we don't want to get in a hot war with Russia. So I think this comes down to what he decides to do in the coming days, remembering that there's this tacit deal with China that he would not upstage the Olympics with a big old war next door. So we could have a couple of weeks, if that's true, to figure this out.
30 seconds. What's the goal of Russia in all of this?
That's a great question. It seems to be stopping the expansion of NATO. They don't want us there at the door. They don't want Ukraine to join NATO. They also seem to feel that, Mother Russia should include Ukraine and those. But look, it's difficult for us to get in his mind right now because he seems to think that we're not up to this. And it'll be interesting to see what he is up to as well. One troop crosses the line. Let's get back together and talk about what happened.
It's so funny. I've been doing an audiobook. It's been taking a while to get through, but it's President Obama, or former President Obama's latest book. And I'm just at kind of towards the end where he's talking about his conversations with Putin specifically. When he wasn't president, Medvedev was, I think, the head of Russia. But it's interesting to say how tricky he was.
That's true. And I'm not sure how much faith that Vladimir Putin has in Joe Biden. So, he's pushing. This is just a massive test, yet another one for this president.
All right, Joe Matthew of Sound On, thank you so much.
Well, let's go to Washington, D.C. for a check of the latest world and national news, where Nancy Lyons is standing by. Hey there, Nance.
President Biden will be speaking with European leaders this afternoon concerning the growing Russian threat toward Ukraine. White House Press Secretary Jen Psaki says it is possible U.S. troops will be deployed to Eastern Europe and the Baltic region.
We've never actually ruled out providing additional support, assistance to Eastern flank countries in advance of any invasion. And those discussions with them have been ongoing, and certainly that's been part of our contingency planning.
Psaki says Ukrainian leaders are not on this afternoon's call, but are part of the ongoing discussions. The U.S. Supreme Court will consider challenges to affirmative action policies at Harvard and the University of North Carolina. Justices have generally upheld affirmative action in recent years, but legal professor and former prosecutor Laurie Levinson says the makeup of the court has changed.
The Supreme Court now has a much more conservative group of justices, and they have signaled that they are likely to say that affirmative action is either not needed anymore or has to be cut back dramatically.
Legal expert Laurie Levinson, the arguments in the case are not expected until next term. Prosecutors in the trial of 3 former Minneapolis police officers charged with violating George Floyd's civil rights accused the men of standing by as fellow officer Derek Chauvin slowly killed George Floyd right in front of them. One defense attorney countered today by saying Chauvin called all of the shots. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masser, Tim Stenovic here at Bloomberg headquarters on this Monday. There's a lot going on. We're watching the markets. We're definitely off for lows. We're going to talk about that in just a moment. There's a handful of stories. Where do you want to go?
Yeah, this one from Janet Lauren earlier in the day caught my eye because, Carol, you and I have talked a lot about standardized tests and the changing view that colleges and universities have about Americans taking standardized tests, and actually any applicant, regardless of where they're from. And now we're seeing that wealthy teens are touting their results that colleges no longer require. So wealthy college applicants are now submitting SAT and ACT scores at a higher rate than lower income peers, even as many colleges, even the most selective, have made such tests optional.
Yeah, this is data from the Common App, Common Application. And if you've had a student who applied for college, you know all about the Common App.
And you call it the Common App. Yeah, if you've been
so cool.
Trust me, if you've been through it, it's the Common App.
It's the Common App. It's the bane of your existence.
Hey, that was even the bane of my existence, and it was relatively new when I applied for colleges.
It's actually very smart, right? Because it's standardized and it made the process a little bit easier. Some 53% of students in the wealthiest households submitted this school year, according to data from the Common App. That's the nonprofit behind that standardized application form. By contrast, only 39% of the poorest did so.
Here's what researchers wrote in a report that was issued today. Figures that were broken out by the socioeconomic status demonstrate, quote, that more work is necessary to effectively engage and support students from across the country's diverse communities in the college admissions process.
Yeah. Well, I think what's interesting, and it's hard to know, and Janet writes about this, it's hard to know in the application process when a growing number of schools are saying we don't need those standardized test results, whether it's the ACT or the SAT, but you don't know that if you do submit them as a student, how that factors in. And no school, I don't think, has really been come forth about saying, okay, if you do submit your test and you did really well, that's going to help your chances.
One thing at issue here is the time and resources that wealthier students have in order to prepare and get help in order to
have the money to do it, right?
Exactly, get their test scores up there.
Which is why increasingly we've seen schools walking away from it. Anyway, it's a great read by our Janet Lauren. Check it out at Bloomberg.com. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Lower on the Fed, Ukraine, and earnings. Stocks are off today's lows amid intense volatility as investors still seek safety in treasuries, with the specter of a Federal Reserve policy mistake and rising geopolitical tensions roiling markets around the globe. Now, the S&P did cut losses by half, but right now we are moving lower with the S&P down 115, down 2.6%. The Dow is down 795, down 2.4%. NASDAQ down 365, a drop now of 2.6%. 10-years up 9/32, 10-year yield 1.72%. Spot gold up 0.2, 18.39 the ounce. West Texas Intermediate crude down 2.8%, 82.74 a barrel on WTI. Losses are mounting for investors who rode the once hot trend of piling into stocks being pumped on social media platforms like Twitter and Reddit. AMC Entertainment and GameStop are tumbling today, bringing losses over the past 2 months to around 60%. GameStop down today by 11.1%. AMC Entertainment down 11.5%. Recapping, stocks lower, S&P down 111 now, a drop of 2.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, we've talked often about the amount of money out there available for startups and new ventures. Turns out one area attracting a lot of VC money is publishing startups, both here in the United States, also over in Europe. So let's get a little bit more on that story.
Yeah, I love talking the news business. And it's not just because of, one of my favorite words, solipsism, right?
Yeah,
the idea that we only exist. But let's get into it with Joel Weber, who's editor at Bloomberg Business Week on the remote access line in Brooklyn. Also joining us is the author of a story in the upcoming issue of Bloomberg Business Week magazine. It's Alex Webb. He's a correspondent for Bloomberg Quick Take. He joins us on the phone from London. Joel, I want to start with you. Is it a good time to be in the news business right now?
Well, I don't know if any business is a good business like right now. Like everything.
Sorry,
seems,
I don't mean today,
air.
with the sell-off that we're seeing, but you know what I mean, because this is one that is, is fundamentally changed by the advent of the internet.
Yeah, so seasonally, if we step back from just today, seasonally there is a lot of money that is sloshing around, and it likes what it sees in publishing, which is not something that you often hear, but I think as Alex will tell us here, what makes this time different, Alex?
The news industry has almost stumbled across a model that seems to work. Now, lots of ifs and buts and caveats, but we've seen a couple of big exits in the past 12 months alone. Even just this month, the New York Times bought The Athletic, and last year we saw Axel Springer by Politico. And it's by focusing on just one discrete subject and getting a really passionate readership that is interested in that one theme you tackle, it seems as though it is possible to create sustainable news businesses.
Well, and it's interesting, too, in terms of what we're seeing, because it makes us, what we find interesting is that, of course, we love media and we see, we're all involved in it. And we certainly see a lot when it comes to video content and certainly streaming and online, but kind of more traditional media. I mean, you do wonder, is this just that there's so much money out there and it's just running into this? And could it turn out to be a big mistake?
Yeah, I think there is, so it's certainly the case that not all of these are going to survive. There is a lot of pasta being thrown at the wall. Only some of it is going to stick. I was a little bit sneaky in my piece where, I asked, is anything fundamentally changed in the economics of news? And I invoked Stephen Moore, who wrote in his book Scoop, whenever the assistant to the big media mogul meant to say no, he actually said, up to a point, Lord Copper. So it's like, actually, not a huge amount has changed, but maybe there's enough money out there and people's news consumption habits have been put off enough by, Google, Facebook, Twitter, what have you, that there's just about enough to keep some of them going.
So part of the difference here now, Alex, is also that we're not talking like general interest publications, right? We're talking like very targeted and niche audiences. Explain that a little bit more, because that's also like a little bit of a throwback to like what you would have once called maybe trade publishing, right?
Yeah, it's really like, well, the examples we've got in the piece, you know, talked about The Athletic, talked about Politico. There's also publications like Airmail, which is kind of like the luxury fashion magazine. It's been founded by Graydon Carter, the former editor of Vanity Fair. Protocol, which is basically a tech publication. Same with The Information. Axios, sort of that nexus of tech and politics. They all kind of go after these discrete segments. And the key thing is really trying to circumnavigate the big tech platforms. You want people to be coming directly to you, your audience to be coming to your website to find their content without having a intermediary aggregating it for you. And so if people want their general news, there's a good chance they're still going to those big tech platforms. But if they want to find out what's happening in the world of tech, these new websites are hoping that they go directly to, for instance, The Information.
Okay, so say I have a friend who has some deep pockets and I have an idea for this thing that I want to do. What's the minimum buy-in? Like, how much money do you really need to actually attempt to get into this space, or at least the quote-unquote successful launches that we're monitoring?
This real or hypothetical, Joel? We're just curious.
It's not
purely hypothetical.
Okay.
You can be, in the grand scheme of things, it can be done for not a huge amount of money. You know, you're looking at some of these companies have raised in a sort of seed round of less than $10 million, which, you know, clearly is not nothing, but it isn't Quibi with, you know, $1.7 billion or whatever it was. And actually, that was part of the appeal of it, that you can go in for quite a lot less than $10 million and you can get a lot for that money. You can get some really big name writers that will bring their audience with them, you would hope. Your setup costs are low because people are working from home. You know, cloud computing means it's not actually terribly expensive to set up a website these days. And so that also means there's quite a lot more upside for the investors who come in because, you know, it's not that much of a risk for them to throw in a little bit at that level. If you're trying to compete throughout the gate with the New York Times or the Wall Street Journal, it's a different challenge.
Hey, Alex, what's the Substack factor here? Because increasingly we see people who have names and followings, not necessarily going to an established media organization or even a startup organization, but going out on their own. What have we learned in the past couple of years as we've seen some people experiment to do this?
Well, I mean, Substack is very much like any social media platform where the early movers have a big advantage. The early movers get the big audiences, but the more people go into it, the harder it is to you know, turn a profit on the level that, or make a reasonable income on the way that the first movers did. And so, to a point, and you kind of think of Substack more as a tool increasingly for some of these new organizations. That Substack, you might build part of your business on Substack. You might build part of it on Clubhouse. You might build part of it on Twitter Spaces. You know, there are lots of different ways, but they're almost tools for these publications, or perhaps the first stepping stone before you build it into a broader media, you would hope, empire.
So what do you think, you know, Alex, in terms of this trend that's happening? Is this going to be, for some of these that do survive and provide some momentum in terms of a business, that they ultimately are tack-ons, add-ons for existing media outlets? How does this play?
Yeah, I wrote another column actually when the New York Times bought The Athletic. In a sense, you saw the original newspaper was the original bundle. An actual bundle arrives in the front door, and we've seen over the past 20 years a sort of great unbundling where people just get the stories they want. I think increasingly you're going to see big news organizations, the big established ones that have been around forever, start to acquire some of these smaller ones because they're buying in an audience, and it's a sort of rebundling whereby, you know, you might offer a subscription to the New York Times and an additional subscription to The Athletic, which is cheaper than buying them both individually. So I think that is going to be the exit for a lot of them. I'm not sure we're going to see massive media empires built in the way that some people might hope.
All right. Well, interesting perspective and trend, certainly that's out there. Alex, thank you so much. Alex Webb, correspondent at Bloomberg Quick Take, joining us on the phone from London. His story is going to be in the upcoming issue of Bloomberg Business Week magazine. You can read it, though, now on the Bloomberg and at Bloomberg.com/businessweek. And our thanks, as always, to Joel Weber, editor of Bloomberg Business Week on the remote access from Brooklyn. In a moment, we're going to head over and talk with our TV team about the markets. We are definitely, Tim, we're off, but we're off our lows of the day. You are listening to Bloomberg Business Week. Carol Master, Tim Stanovic. This is Bloomberg Radio.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
And this is Countdown to the Close. 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic. Of course, we go cross-platform, TV, radio, YouTube, to lay our bets on whether we end up in the green, Carol.
That's a really good bet. I don't think so, but we're certainly not going to be down as much as we were earlier in this session. I feel like we're seeing some investors, Tim, come into this market.
Yeah, I've been digging into breadth with the major indices. The NASDAQ 100, interestingly enough, in terms of the percentage of members above a 200-day moving average, it's only about 39% of members that are above a 200-day moving average. It hasn't been that low since April of 2020, so some serious selling happening.
Yeah, I mean, we're still getting into a lot of key technical levels that in the past we've seen provide a little bit of a bounce higher here, but the question really is, do you front run the Fed or before we get some clarity out of the Fed on Wednesday, or do you wait until Wednesday till you have a little bit more clarity? Do you wait until we get earnings out of Microsoft, Apple, and the like before you start to jump back into this market?
I love that. Of course, talking about fundamentals as we think about big days and sort of the broad sell-off. And I think we were talking earlier on this program, Caroline, about the CEOs and hinting, and a lot of analysts were coming out and saying that, well, they typically issue conservative guidance in the first quarter, and maybe they were hinting that there were some real concerns on the horizon.
Let's dig into the benchmarks, because what a day. At one point, off by 4% on the NASDAQ. Not now. We're off by 1.5%, but the volumes are big, 57% compared to usual average over the last 20 days. The S&P 500 down by 1.6%. That's 71 points lower. At one point, we were 1,000 points lower on the Dow. We're now half that, 489 points lower. We're still off by 1.4%. The Russell...
You know it's big when we start quoting Dow points.
I was going to say, Caroline, Romain's going to roll his eyes at you.
I knew you were going there.
Poor Dow.
Maybe we should make Russell 2000 our go-to, because it's in the green. Up 10 points.
There you go, points. Let's take a look at the sectors, Caroline, because you bring up a good point in terms of where we are. For the year, there's still only one major sector in the green, and that is energy. And on the day, energy is still the outperformer, though I think it's notable that the big outperformer on the day is still off about 1.4%. And yes, that is energy. Everything else looks like a pretty broad-based sell-off, but Romain, we really point to the bottom. Of course, technology, it is in there. The sector on the S&P is still off about 2%, but everything else, real estate, healthcare, utilities, you think about those bond proxies and those inflationary trades, those are some of the worst performers on the day as well.
Well, flip up the board, because I think there's two stocks really emblematic of the push and pull that we're seeing here on this day. You talk about Netflix, which of course had that massive sell-off on Friday, down again today. It was down more than 10% at one point. It's down 6% right now, so there's still some pessimism out there right now. I want you to take a look at, though, at Etsy. Etsy shares right now are in the green. This stock started the day well lower. It was down 8.6% earlier in the day, heading for what was going to be its 11th straight day of losses. Actually, I believe something like the second biggest decliner in the S&P 500 so far this year. But it did reach a threshold where at least some folks maybe saw a buying opportunity. So those shares are higher by about 1.7%. I think a little bit later, Taylor, you're going to talk about Kohl's and some of the activism surrounding that stock. Those shares up 32%. And we got to mention Square, which of course has officially changed its name to Block. Those shares down 4%. Of course, coming off the big name change and the pivot here to crypto and Bitcoin, which had some, I guess now, interesting timing.
Yeah, interesting timing when crypto was at about 33,000 earlier. Meanwhile, let's have a quick look at what's happening in terms of, this wasn't the chart, but I can definitely do that. There we have it. Like magic, our production team just brings it there to the fore. For our radio audience, we're looking at value versus growth, but this is basically an old school take. Berkshire Hathaway versus ARK Innovation. The volumes you saw on the ARK Innovation ETF today have never been seen before, but over the last 2 years, when you chart it now, we now have them both having performed some 35% higher. But for Berkshire Hathaway, slowly, you get the gains. ARK Innovation, you managed to erode most of them, and now you're up just 35%.
For our radio audience, I just want to illustrate this chart here, because there's a blue line that's basically looks like an EKG machine. Then there's a white line that's basically steady and up to the right, which is, I guess which one is which.
Is that the hypothesis?
I mean, in all seriousness, and not to rag on ARK or anything, but there's the idea of, okay, you can make outsized gains in this market, but you're going to deal with a lot of volatility to get there, or you could take maybe a safer route and probably still get rich, but without, a lot less agita in the process.
Yeah, absolutely. Very different tones, those two individuals, whether it's Kathy Wood or Mr. Buffett there. Hey, having said that, I think all bets are off. Caroline, you asked me, do you think we're going to end in the green? I think all bets are off until we get that Fed meeting tomorrow, and whether or not, there's so much. What?
I said that.
Okay. Oh, okay.
Welcome back, by the way, Carol.
Thank you. It's good to be back with you guys.
We missed you.
I missed you guys. So let's listen to Megan Green over at Kroll. She is their chief economist over there, and she said, add this to your list of worries, and that is the concern about a Fed policy misstep and a recession. Check it out, everyone.
If you look at the history of Fed rate tightening cycles, almost all of them have landed us in a recession. So the Fed's history isn't great on that front. Yeah. And also, I do think demand will be waning significantly this year. And that as we address supply chain issues in the second half of this year, demand weakens, both domestic and foreign demand, given the slowdown in China. We're going to be having a very different conversation around inflation. I think it will look much less scary than it does right now.
All right. That, of course, is Megan Green over at Kroll. What's interesting in that statement, I just feel like there's still so many questions. We don't exactly know how the Fed's going to do it. We don't know how inflation's going to play out. We are seeing weaker economic points, Tim, but there's still a lot of questions about what ultimately happens over the rest of the year.
Yeah, at what point does inflation peak? And also, of course, we hear from the Fed this week, as we all have mentioned, and you have to wonder, look, like we talked about it last week, this is not part of the Fed's dual mandate, but they're data dependent. They're not going to ignore what happened in the markets at the start of the year. And how does that change what they're asked on Wednesday and what they talk about tomorrow on Wednesday?
And how much are retail investors hurting right now? There's some interesting points as to how much actually some of the meme trades have faded since February. This isn't new, a lot of this sort of risk off. This isn't the Fed, this isn't inflation. This is actually some of the risk taking that we saw at the very beginning of 2021 having faded for a long time. But now it seems to be institutional players that dictate the market.
This is Jim Chano saying that he's worried about the retail traders in the current economic rout, of course. And I think, Caroline, you bring up a good point, and always interesting to talk about the market is not the economy. And if you have a Jay Powell who's focused on the economy and inflation, can you ignore some of the blips in the market here on out?
All right. If we end in the green, I'm going to eat mashed potatoes. I'm also going to eat mashed potatoes if we get 2 rate increases or 50%.
Mashed potatoes anyway.
I don't like
She's not a fan.
This would be, anyway, we're going to be back, everybody, at 4 p.m. Wall Street time.
Did I miss a mashed potatoes discussion?
Yeah, we had it on earlier.
Get back on crinkles.
Somebody said that we could see like a 50% rate increase by the Fed come March. And I said, I'll eat mashed potatoes if that's the case, because I don't think that's going to happen. Bet. And I don't like mashed potatoes. Okay. Anyway, we'll talk more at 4 o'clock. We'll count everybody down to the closing bell. We're going to come back with our simulcast coverage of Beyond the Bell, live on radio, on TV, and YouTube. We're going to take you through the market close on this Monday.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I don't like mashed potatoes. When I was a kid, there were 7 of us kids. We had a lazy Susan in the middle of the table, and for those of us who didn't like mashed potatoes, they got shoved under the lazy Susan. And then when my mom would be cleaning up, she'd be like, "Oh my God, who's not eating the mashed potatoes?"
That's disgusting.
I just don't like them.
What about sweet potatoes?
Love.
Okay,
love.
So it's.
But I don't like them mushed. I like.
What about French fries?
Kind of love them, but I like things crunchy, and I don't like that mushy texture.
Okay. Hey, let's talk a little bit more about markets and what we're seeing today. Caroline mentioned Bitcoin.
Yeah.
And it's actually higher, right above 36,000 right now.
Okay.
It's still down roughly 50% from highs just a couple of months ago, but it's kind of struggling for direction today, I think it's fair to say.
Yeah.
Because it was, 30,000 was the level that we were talking about early this morning.
Yeah, it was down about 7% almost, and now it's up about 2%. It was up as much as 3.25%. Paul Sweeney earlier on Bloomberg Radio talking with Tom Keene, and they're saying, it might be an entry point, as Tom said, entry point for who?
Yeah.
Or whom? It's still pretty pricey, but it's definitely come down. I don't know how you treat that as an asset against the rest of the financial markets. I don't even know. Can I say asset? I don't know.
Yeah, I mean, but like Katie talked about with us earlier, it's been behaving more like a high-flying tech company.
Okay, and that's maybe fair.
Yeah, but it's not a hedge for inflation.
No.
At least it hasn't been lately.
What I think is significant that we are seeing a bounce off the lows ahead of that Fed meeting tomorrow. So does that mean investors are thinking, you know what, the Fed's going to maybe be a little bit slower. We've all been kind of, getting very nervous, thinking the Fed's going to be incredibly aggressive. I think, what the Fed's going to do is they're going to be data dependent, and they are going to spoon feed us everything so that we're not shocked.
Okay. Not mashed potatoes, though.
Not mashed potatoes.
No, that's it.
Yep, no doubt. All right, let's get to world and national news. Over to Nancy Lyons. She's in D.C. Do you like mashed potatoes?
I love mashed potatoes.
What's wrong with you people?
So sorry, I don't understand it. Anyway, President Biden is holding a phone call at this hour with European leaders to discuss possible action if Russia moves into Ukraine. One option would be to beef up NATO forces along the border. Pentagon spokesman John Kirby says Defense Secretary Lloyd Austin has already placed 8,500 U.S. troops on heightened preparedness.
No mission has been assigned to these troops. No deployment orders have been sent to them. What the Secretary has ordered them to do is to be ready to go, in some cases, on a much shorter tether than what they had before.
Kirby says the U.S. troops would be part of the NATO response force and would only be activated by the alliance. The U.S. Supreme Court will be taking up a case on whether to abolish the use of race in college admissions decisions. It involves appeals from Harvard and the University of North Carolina. The court will need to decide whether to overturn Supreme Court precedents that let schools consider race to help create a diverse student body. People are still talking about the NFL playoff games over the weekend, where the outcome of multiple games was decided with a winning field goal. But the Buffalo versus Kansas City game was one for the ages, with more than 25 points scored in the final 2 minutes, leading to overtime. Kansas City quarterback Patrick Mahomes says he's glad they came out on top in overtime.
To be able to come back a couple of times, get points when we needed to get points, score touchdowns, get in field goal range, let Butker kick field goals. I'll remember it forever.
The divisional finals will be held next weekend. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Nancy Lyons.
That's the mashed potato loving Nancy Lyons. I'm
Hey,
just
me
going to
too.
put that out.
I'm on Team Nancy Lyons.
I know.
And I guess everybody else listening, because you're kind of the only one, Carol.
What's wrong with you? So I'm the odd person
You are.
out.
And look, when in doubt, just
It's
put as
just
much
squishy.
butter on as you can, and it turns into butter, and it's just fantastic.
My gosh. And my mom was a great cook. And everybody else in my family, I think, liked them, except for a few of us who stuck it under the
There were a
lazy
lot of you.
Susan. There were a lot of us. The most read story on the Bloomberg today makes sense considering the market sell-off that we've seen, although, as we've been mentioning, we are well off our lows of the session. The strategists who saw this miserable stock rout coming say, dun, 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 there is still more pain ahead.
All right, buckle up, everyone. At least that's according to one strategist, or several, actually. With the S&P 500 sliding more than 10%, bears from the likes of Mizuho International and Bank of America warning of fresh selling to come as growth momentum eases, just as the Federal Reserve amps up borrowing costs.
All right, so check it out. Mizuho's strategist who came into 2022 warning of a 10 to 15% plunge in the second quarter, if not sooner, said the S&P 500 could slide another 12% as a, quote, tightening tantrum gathers pace. A slew of factors, stretch valuations, tech-heavy indexes, and rising yields is playing out in a route that shows few signs of abating. I will say, though, again, we're off our lows. There's also another story on the Bloomberg that says, and Megan Green also talked about this in terms of, I think, Fed tightening cycles. I mean, she talked about that it often leads to a recession, so that's something to think about. But there's another story on the Bloomberg that talks about some research over by Truist Co-Chief Investment Officer Keith Lerner that says stocks have historically performed well during periods when the Fed raised rates, as a growing economy tends to support corporate growth, profit growth, and the stock market.
That's interesting.
Because the Fed obviously feels confident enough to raise rates and take off some of the liquidity measures because it feels like the economy is okay on its own.
I'm still having a hard time, Carol, understanding like what it was that shifted in terms of the Federal Reserve in recent days. I go back to what happened with Netflix last week, and this kind of sending concerns throughout the markets, and what we heard from Netflix doing that, because we haven't.
But that's a company story, right?
I know.
They're not going to grow at the crazy rates that they saw, but they still have lots of users. Just saying. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We're off session lows as investors focus on the Fed, Ukraine, and earnings. The Dow, the S&P, NASDAQ are all declining. For all the details, lots going on. Let's head right over to the first word breaking news desk for today's afternoon call. Here is Bill Maloney.
And good afternoon, Charlie. U.S. stocks are sinking today again, but like you said, well off their worst levels. The Dow's currently down 432 points, was down 1,100. S&P's dropped 60, while the NASDAQ pares losses to 150. The U.S. 10-year yield at 1.73%. Gold is little changed. Oil is down, but Bitcoin is now higher after being down 6.8%. Among the main 11 S&P sectors, all are still in the red, led by losses in utilities and healthcare. Leaders to the upside in the Dow, Home Depot, and Travelers, while Visa, Merck, and J&J led to the downside. In deal news, Blackstone to buy Resource REIT in a $3.7 billion apartment deal, and Kohl's is surging 33% pre-market as the retailer is fielding interest from two suitors. In other news, Dow Jones reported prepared to deploy orders have been issued to troops at several bases. And wrapping things up, IBM reports after the bell. Live from the first and breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill, and to hear live breaking news.
What
over
happened
your
to
Bloomberg
2 months ago
when UAWK on your terminal? I'm Charlie.
We're talking declaratively about I'm going to shut
All right, Charlie,
down
thank you so
the
much,
virus.
Peloton. The story that keeps on giving.
I'm not going to shut down the country.
Keep pedaling.
Keep pedaling. Well, activists are out big time already here in 2022. You know that the latest target, the once pandemic darling turned post-pandemic pariah. We're talking Peloton. So let's get to what's up. Scott DeVoe is with us, deals and shareholder activism reporter at Bloomberg News, on the phone here in our New York City bureau. You've got to be busy this year, man. There is a lot going on when it comes to the activists.
Yeah, I didn't get to watch as much football as I wanted to yesterday.
I'm so sorry. There were really good games, one after another. Peloton. So they're checking out Mr. Foley. What's going on here?
Who's the superhero that's going to speak against
the investor,
Joe?
the activist in the stock is Blackwell's Capital, and they released a letter this morning essentially calling for Peloton to fire John Foley as CEO and to put the company up for sale.
And, you know, last week we heard analysts weigh in on this and the idea that, you know, Apple or Alphabet, for example, Alphabet is what Jason Helfstein said over at Oppenheimer, could be a good fit to acquire Peloton. What are the other names being thrown around?
Nike, any kind of technology company, any kind of fitness company probably would fit well with this because of the data that it would bring. I think, there's been a lot of speculation that these guys would be a very good target for a lot of companies.
Well, it's interesting. It's a lot cheaper than it was, that's for sure. Tim and I were trying to figure this out. We thought that John Foley and a lot of other seniors controlled the voting shares. Are there a couple of different classes? Like, give us an idea.
That's the big problem here. Actually, it's an unusual time to go public, I guess, because the annual general meeting was held in December, so it'd be a full year before you could nominate directors to the board, and it does have a control block. So they could prevent anything from going forward just based on that. So it does have a dual class share structure, which usually prevents activists from targeting those kind of companies.
So what is Blackwell saying about John Foley and about Peloton leadership?
Well, there's a litany of complaints, basically, that is in the letter. But essentially, Blackwell's is saying that they've failed on forecasting. They've had an inconsistent strategy in terms of pricing that's confused consumers and analysts. They have governance issues and a lack of financial controls. One of the big complaints is that John Foley told investors that there was no need for capital weeks before they did $1 billion stock offering. And so there's just a very long list of complaints. And obviously, last week, the the stock hit a 2-year low. It's down 80%, since pandemic peaks when people were exercising from home at a higher rate. And it seems like, Peloton's on its heels right now, and they're going public at a time when, they really need to come up with a plan to fix the ship.
Well, Scott, you are the deals and shareholder activism reporter, so you cover a lot of this stuff. Is there anything that sticks out to you that's sort of different than the typical activist getting involved here?
I mean, it seems to me that it's a very typical target, and because it's a very high-profile brand, that those things tend to attract activist investors. I mean, I think everybody knows what Peloton is, but maybe don't know that they're in a difficult position now. I mean, they've slashed their annual forecast by about $1 billion. And it seems, that they had a really good, and the complaint in the letter is that Blackwell says, you had a really good opportunity during the pandemic to turn people onto the Peloton product, but instead what's happened is, the stock has suffered as people are getting out of these, pandemic restrictions and returning to the gym and whatnot.
Yeah, it doesn't help. Was it our social media buzz newsletter that went around too that, I guess Billions, the Showtime show Billions featured a scene in which a character dies while running the bank as well.
Spoilers for people who aren't caught up.
Sorry.
Sex and the City, I think, yeah.
No, it's also
too?
Billions.
Okay.
It's the second time.
Everybody's dying on Peloton.
It's like, whoa. It is interesting, though, and you do wonder if there were too many missed opportunities. What's the timeline? Do we have a timeline as investors as we watch this thing unwind?
So so Peloton has their earnings in a couple weeks in early February on the 8th. I would suspect that they would have replied at least to at least try to frame the narrative in more favorable terms, but they've been completely silent at this point. So I think with that earnings coming up, that'd be an inflection point probably to see what their alternative plan to sale and firing John Foley would be.
All right. Well, investors all over the place. Stock's been down as much as 4.5% today. It's been up as much as almost 12% right now. It's a gain of 8.6%. So it does look like, Scott, that they're expecting something. Scott DeVoe, thank you so much. Deals and shareholder activism reporter at Bloomberg News on the phone in our New York City bureau. What do you think?
I don't see Apple doing it. Apple builds its own hardware.
Yeah.
And this company has too much hardware. People would counter that with, but Apple bought Beats years ago. Well, yeah, they bought it not for the headphones. They bought it to build the streaming platform on.
That's a really good point.
But other companies, perhaps. Look what Under Armour did with Map My Run.
Right,
Maybe
exactly.
Nike does this.
And you do automatically get a certain base if you want to get into this market. $9.6 billion market cap as we speak. This is Bloomberg.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yeah, you're listening to Bloomberg Business Week. On this Monday, we're off to a rough start, certainly a risk-off kind of day, to say the least, but we have seen some investors coming back into the market, helping to push stocks off their lows of the session, but we're down across the board.
You and I have been talking on mic, on camera, off mic, on camera, about what really sparked the sell-off. Kriti Gupta is going to be joining us in just a few minutes, and she's got an interesting chart. It's called Apple Sparked the Sell-Off, the Dollar Can Rescue It. So we're going to hear from her.
Ooh,
yeah.
I'll stick around for that one.
Her on that. Hey, in the meantime, let's get a check of that trading day. Less than a half hour from the close. Here's Charlie Pellet.
Very much going to be very interesting to see how things shake out. With 28 minutes to go ahead of the close there, you guys talking about Apple coming up with Kriti. Apple shares right now, they are down by 2.1%. But look at the Dow, the S&P, and NASDAQ. Yes, red on the screen, but the bottom line here, very much off session lows. At one point, we had the S&P down 175 points, down 4%. The S&P is now lower by 36, down 0.8%, well off session lows. The Dow, which had been down more than 1,100, now down by 234 points, drop there of 0.7. NASDAQ down 67, drop there of 0.5. Going to be very interesting again to see how things shake out heading into the close. Stocks off Monday's lows amid a flood of trading activity. Investors still seeking safety in treasuries as the specter of a Federal Reserve policy mistake and mounting geopolitical tensions roils markets around the globe. Investors are also very much focused on earnings. IBM will be among the names reporting after the bell today. IBM right now down by 1.5%. 10-year yield 1.74%. Spot gold up 0.2%, 18.39 the ounce. West Texas Intermediate crude down 1.8%, 83.60 now for a barrel of WTI. The World Health Organization says Europe is entering a new phase of the pandemic, driven by Omicron's milder symptoms, lower risk of hospitalization, and the efficacy of vaccines. Dr. Joshua Sharfstein is vice dean of the Johns Hopkins Bloomberg School of Public Health, and he says while there are encouraging signs about the easing of the pandemic, it is still too early to stop taking the precautions that we've all become accustomed to.
What's been pretty, stable as we've learned about the virus is that when people aren't wearing their masks and they're talking with each other indoors, that's when the virus spreads. So I think, people wearing masks in public transportation is turned out to be relatively safe. And on the other hand, a pizza party with 20 people in your house, which, has happened to a number of students in different places, that turns out to be everybody gets COVID if it's Omicron.
Dr. Sharfstein with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Again, checking some of the vaccine names. Pfizer now down by 3.8%. Its German partner BioNTech, its ADRs now higher by 1.3%. AstraZeneca's ADRs down 4.4%. Moderna lower now by 4.4%. J&J down by 2.4%. Again, recapping well off session lows. Look at the S&P now down by just 0.6% for the S&P, drop there of 26. The Dow down 188. That is the story of the day recovery here, down 0.5. NASDAQ down 38. Drop there of 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Carol, do you remember just recently we were talking about Apple hitting $3 trillion in market cap?
And here we are.
And here we are. What a difference just a couple of weeks it makes. Hey, that's really what got Kriti Gupta thinking about this chart of the day. Kriti is Bloomberg Markets correspondent for Bloomberg News. You should sign up for her chart of the day. You can do that at kgupta129 at bloomberg.net. Also, check out her Twitter and Instagram. You can do that at Kriti Gupta News. Kriti, Apple sparked the sell-off. That's your thesis, but the dollar can rescue it. Please explain.
Yeah, absolutely. So a couple weeks ago, I wrote a story. This was December 28th to be exact. It was when we were on
$3 trillion watch for Apple's market cap. And I wrote a story that looked at the last time that Apple had hit their $1 trillion milestones. And it turns out it was right at the start of the fall of 2018 and then right at the start of the tech wreck of 2020. Essentially, Apple hitting that milestone, which we should know is also a heavyweight in the S&P 500, kind of triggered this market meltdown. It triggered these technical corrections. So basically, I took that historical pattern and I said, well, if it hits $3 trillion again, it is very plausible that it would have another technical correction in the S&P 500. And lo and behold, here we are. Apple hit that $3 trillion market cap on January 3rd. Starting January 4th, we went into a correction that resulted in a 10% drawdown as of today. So that's really what my chart of the day looks at, essentially not just that Apple sparked the sell-off, but what kind of rescued it historically. If Apple was kind of peak for stocks, what is the bottom of the stocks? And I found that the kind of historical pattern has also been in these corrections, at least for the past 3 years, has had everything to do with the dollar. The idea that a lot of the tech-led gains are kind of driven by foreign flows. And how do you get foreign investors to hop into the stock market? Well, you do it by kind of making the gateway, which is the US dollar, just a little bit cheaper. And every time the dollar is weakened, you've seen those foreign investors hop back in. So it kind of seems like that's the signal the stock market may be waiting for to see the sell-off reverse.
It's all connected though, right? Higher rates usually mean a higher dollar. I just think about and Apple hitting that market cap, it was also as the rest of the high flyers in the tech sector, right? We're continuing to grind higher and higher. So it's all kind of this wonderful connection.
Yes, if only.
Right?
And I think, and I think to your point, I think when you look back at what happened in 2018 and what happened in 2020, which were the last two corrections, you did start to see that there was this kind of buildup in the dollar. Now, at that point, you didn't see necessarily all of it being monetary policy related. In 2018, you definitely did, but not necessarily in 2020. 2020 was more about the election. It had to do with kind of whether Joe Biden or President Trump would be reelected. But you did see this buildup in the dollar, to your point. And I think you're seeing that again. This time is definitely because of that hawkish Fed policy. And what's interesting is that the natural trade when you have a hawkish Fed is to bid up the dollar. But if you look at the historical pattern, you actually need the dollar to weaken to stop some of the pain in equities. I don't know if we're there yet.
Hey, Kriti, we always love to go just with the last minute that we have with you to the story that caught your eye today. Another story about international relations. Take us into it.
Yeah, well, this is a story that I don't think enough people are talking about. We've heard about Russia, Ukraine. We've heard about China, Taiwan. No one is talking about the UAE, which is one of the key production kind of countries of oil around the world. They are actually dealing with Houthi missiles from Yemen. Remember back in 2019, these Houthi missiles actually hit an Aramco facility. It created a massive spike in oil prices, and it's kind of going that way again with Abu Dhabi and the UAE in particular. So that's my story of the day. Just keep an eye on essentially the geopolitical tensions in the Middle East, because at the end of the day, it could start to impact oil production.
Yeah, always smart to keep an eye on that region. All right, Kriti, thank you so much. Have a good evening. Kriti Gupta, Bloomberg Markets correspondent at Bloomberg News, with her chart of the day, and something she's keeping an eye on. As Tim mentioned, you can sign up for her chart of the day at kgupta129 at bloomberg.net.
You're very close to eating mashed potatoes.
I'm really nervous.
For the NASDAQ, okay?
The S&P's down only 18 points.
Yeah.
The NASDAQ's down 7.
Yeah. Hey, let's get an update on world and national news. Nancy Lyons is standing by in D.C. Hey, Nance.
Thanks, Tim. The Pentagon says it is putting 8,500 troops on heightened alert for possible deployment to bolster NATO forces amid Ukraine tensions. Pentagon spokesman John Kirby says it's still a conversation the U.S. is having with its allies.
We're still in consultation with the allies about what they might need. And so I don't have any decisions to read out in terms of specific locations. But we certainly have made it clear to the eastern flank allies that we're prepared to bolster their capabilities if they needed.
Kirby says at this point, no deployment orders have been issued by NATO. President Biden has been holding a virtual conversation with European leaders this afternoon to discuss next steps. Well, President Biden is taking aim at inflation to begin his week. Bloomberg's Nathan Hager reports from Washington.
The White House says the president will meet with members of his administration this evening to talk about lowering prices. He's taking part in the second meeting of the White House Competition Council. The first was held last September. This evening, the cabinet-level council is expected to provide a progress report on efforts to promote competition and get prices down. Treasury Secretary Janet Yellen and Attorney General Merrick Garland are among those taking part. In Washington, I'm Nathan Hager, Bloomberg Radio.
Tax season begins today, and already the IRS is warning it could take a while for returns and refunds to be processed. The agency says years of funding and personnel cutbacks, as well as a backlog from previous years, are all making the situation worse than usual. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, I am pulling up all these. Is it Jiffies or Giffies? Jiffies?
Oh, I just had this conversation with David Myers, executive producer of Bloomberg Quick Take. It's GIF or GIF.
GIF or GIF?
He calls them GIFs, I call them GIFs.
All right, well, GIF or GIFs, I've been pulling up all these mashed potato ones. Right now, we're back negative on both the on the NASDAQ, which went into positive territory for a moment.
So what is the deal? If we close in any of them, if any of them close in the green, then you're eating mashed potatoes?
I guess so.
All right,
we'll see. I got some. I still got 20 minutes or so.
Yeah, you do. And there's hey, not that you're rooting for it to go one way or another.
I'm not.
Mashed potatoes.
I'm totally objective. Markets are markets. In the meantime, speaking of markets, one that continues to grow is musicians. You know them well, and they keep selling out their catalog of music.
I saw this and I thought, wait, I thought Bob Dylan already sold his catalog. I'm not kidding. I saw this.
That's because we often get an email where it's like, didn't he do this?
I thought he did this already, but here's the latest, among the latest from Lucas Shaw. Bob Dylan selling his entire catalog of recorded music to Sony Group. This is just the latest example of musicians cashing in on a wave of deals sweeping the industry.
What is, come on, we've seen this with John Legend, we've seen it with Bruce Springsteen, we talked about that with Dave Wilson, big time. Billboard estimates that the recordings are worth at least $200 million. The deal struck in July, announced by Sony today, and it's a sale of his songwriting catalog to Universal Music Group, or follows, I should say, the sale of his songwriting catalog to Universal Music more than a year ago. So you continue to see them monetizing. Why not?
Oh, that's what I was thinking of.
See, so you're not so crazy.
Okay, that was entire catalog of recorded music versus the songwriting catalog. A very important difference.
So he's securitizing it, dicing and slicing it?
Well, look, I'm not going to speak out of turn and talk about music rights here because that is something that we need Lucas Shaw to come on and talk to us about because it's incredibly complicated. What's important, though, to keep in mind, Carol, is that as Lucas writes, back catalogs have found new value in the online era as streaming services like Spotify produce billions of dollars in annual sales for the industry. Investor groups, they've been getting in on it.
Right. There's a lot of new markets, right? And everybody wants, again, content. And so you're seeing it. Remember Bruce Springsteen, he sold his catalog last month. That deal was worth more than about $500 million, according to Billboard. Big one. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. What a wild ride this day has been. We have got NASDAQ now trading at or near session highs. NASDAQ in the green. At one point, the NASDAQ Composite Index was down 674 points. But right now, running the GIP function on the Bloomberg, we have got NASDAQ up 11 points. Again, best level of the day, up by 0.1%. S&P paring its losses right now. 13 minutes to go. Got to keep it locked in to see how things shake out at the closing bell, and of course how Asian markets react tonight. S&P now lower by 11 for the S&P. That is a drop right now of 0.3%. Again, worst level. The S&P was down 175. That was a drop of 4 full percentage points. We've got stocks pairing the drop with the Dow Jones Industrial Average now down 34 points, drop there of 0.1%. At one point, the Dow had been down more than 1,100 points. Those dip buyers emerging. Will they stay after a sell-off driven by concern over a Fed policy make and mounting geopolitical tensions at royal markets around the globe? Also on investors' minds, throw in earnings. Right now, we have got IBM scheduled to report after the close of trading today. 10-year yield, 1.75%. Spot gold up 0.3, $18.40 the ounce. And West Texas Intermediate crude down 1.7%, $83.67 a barrel. Bottom line here, rebound for stocks, a wild session. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
China is the last major nation pursuing a zero-tolerance COVID strategy, seeking to extinguish outbreaks of the virus as soon as individual cases emerge. But the highly transmissible Omicron variant is testing the government's approach. Chinese officials have adopted strict measures to control emerging infections, such as locking down entire cities and mass testing millions of people. But Omicron has nevertheless spread to China's largest population centers. That includes Beijing, which is hosting the Winter Olympics in a few weeks. Given how fast this latest COVID strain travels, China has little chance of keeping case numbers low. Meanwhile, the human and financial costs of overzealous lockdowns are mounting, and public patience is wearing thin. China will probably have to abandon its zero-COVID policies at some point, perhaps sooner rather than later. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
I'm definitely going to be eating mashed potatoes.
Explain what's going on, Carol.
So investors who want to be in this market, things have been on sale, right? It depends on which part of the market you're looking at. Small caps, large caps, tech, 10%, 20% lower. They've been on sale. And so you've definitely seen some buying. Let's see what Hank Smith has to say. See if he and his clients have been doing some buying. He is head of investment strategy at Haverford Trust Company on the phone from Radnor, Pennsylvania. I said that I would have to eat mashed potatoes if we end in the green today. I do not like mashed potatoes, Hank Smith, and it looks like I'm going to have to be eating them because we are in the green.
Yeah, what a remarkable day for sure, Carol. Good afternoon.
Hi.
But look, this is we're now officially in correction territory for the S&P 500. This is the first correction in nearly 2 years since the bear market that ended on March of 2020, and that is so unusual to go this long. We were really spoiled last year. But at the same time, dare I say, we still believe this is a TINA market. There is no alternative because stocks still look much more attractive than bonds. Even though rates have come up, they're still, relatively speaking, very low. And people buying bonds today are buying losses if we continue to have higher interest rates. So I still believe that this is a market to buy these kinds of big dips.
Wow. I mean, but there was something that fundamentally shifted late in the day here, because there was no dip buying happening in the morning. Do you think this was something technical? How do you explain it?
Well, no, you're absolutely right. And in the previous rallies earlier, in the last several weeks, those were very temporary rallies. Those were opportunities to sell. But now that we have the correction out of the way, I think it's highly unlikely this morphs into a bear market, because bear markets occur in anticipation of recessions. And it's really unlikely we're going to have a recession over the next 12, 15 months. You still have a consumer flush with cash and pent up demand to spend once we get a little clearer from this COVID. And you have corporate profits that are excellent. Sure, monetary policy is changing, but it's still stimulus, just not as much. And fiscal policy is still stimulus, but not nearly like we've seen last year. But I still think we're going to have decent economic growth, decent corporate earnings. Yes, more volatility this year, but last year was a very unusual year with almost zero volatility.
Hey, Hank, did you say bear market or bull market?
Bear markets. So the S&P now is down. Depending on how we close today, down 11% off its peak.
Yeah.
That's correction